Hey folks, we're finally seeing the last legs of the speculative market bubble bursting, and the last leg, the final domino to fall, is real estate, and a particular kind of real estate we're going to be discussing in this video because I live outside of Toronto and the surrounding Toronto areas where we're going to fixate on because we are seeing a crash, upwards of a 30% drop in real estate prices since February. But even if you live in the US, you're going to find some tidbitted information that I think would relate to even where you live. So if this is a conversation you can appreciate, hit that like button, folks, because before we talk about the real estate market, we need to talk about the bubble that we're seeing bursting and why I think it's finally coming to an end. Now, the bubble bursting is kind of hard to wrap your head around because it is not an all market bubble burst. And in this recessionary period, what we usually see outperforming is things like commodities, right? Especially driven from that geopolitical event when we're talking about fertilizers, energies, fuels. And it's no surprise that when we look at the S&P TSX composite, very similar to the S&P 500, but on the Canadian side of the border, the most of the components and the individual stocks in this composite, guys, are financials and energy companies. So it's no surprise that the TSX has outperformed almost every country or every stock market globally this year. And comparing it to things like the NASDAQ, that's down 24%, which is largely driven by growth stocks, right? Or basically fundamentally really good growth stocks, because these are large caps like Microsoft, Apple, Nvidia, Amazon, and those companies, though, have really good fundamentals. They really got speculatively hyped through that March 2020 period, right? When the government was pumping out a lot of dollars, interest rates were at record lows here. And because so many of those companies were based off future forward-looking growth expectations, it's no surprise that they are seeing some of the biggest hits. But even still, the hits the NASDAQ is taking are nothing in comparison to individual companies that were highly hyped through that period. You can look at a Canadian company, the only Canadian large cap tech company like Shakepay, which is now down 73%. If that is not a bubble deflated, I really don't know what is. But if you really want to look where the crash was, guys, the innovation ETF. That's right. Cathie Wood, one of the pronounced singers that, we're seeing a new transition in life. And I love Cathie Wood. I think a lot of what she says is true, but it's quite clear that, the small caps and growth companies she was focused on were the biggest part of that bubble that burst. And most people aren't really fixated on crypto outside of altcoins, but Bitcoin obviously has crashed pretty miserably here as well, down 40% year to date, guys. And these are just the real speculative aspects of the market that were highly inflated that have now fully corrected. And it's no surprise this isn't largely impacting the larger indexes because, again, a lot of the companies in the larger indexes didn't get dragged into that bubbly speculative aspect of what we've witnessed correct. Now let's talk about the real estate market in particular. Now, the reason I preface this is the speculative aspect of the market is because that's what we're going to see correct in the real estate market. There's two pieces you have to pay attention to: growth markets and obviously where we're talking about development, because primarily, guys, where I live, Toronto, the surrounding Toronto area, nobody is really fixated as much on cap rates. I'm talking about rental units where people are trying to buy it based off rental income and making the numbers work. This is primarily a growth-based market. And in under just over a year, right, the GTA has seen home prices double. Toronto, in a couple years, the prices have doubled. We're seeing insane growth rates over a 5-year period as high as 30 to 40%. That is extremely unsustainable, and I've been calling it for a while now. The Canadian real estate market has been in a bubble. So let's talk about GTA home prices cooling off. Now, this hits close to home because my mom recently sold their property to go into retirement, very big farm property, and they got an insane number last year for this house that they sold. But let's just talk about where the market's correcting the most in the GTA, and that is in freehold townhouses, because they went from 1.24 million. They're dropped 22.6% to an average price for April of 960,000, just coming from February. This is just in under a quarter period, right? Which is just mind-boggling. Detached homes, 1.65 million to 1.45 million, down 12.1%. Semi-detached down 13%. And condos, obviously, they don't go up as much, but they don't go down as much or as fast either. So they're seeing a correction of about 6.8%. But where the data really gets interesting is in the individual municipalities. Now, I live personally in Brock Township, and it is just wild to me to think that the prices have dropped 29.25% on average, with Georgina, East Quillenberry, King, Stouffville, Milton, Oshawa, Whitby, Halton Hills, Caledon, Mississauga, Brampton, and Markham, including Uxbridge, seeing the largest impacts of over a 10% correction. And then as we kind of get more closer to the city, we're seeing a less corrective period. I'm finding I still feel like Toronto is just kind of slowing down a bit, but we're going to talk about Toronto in a second, because the only place that's seeing real green is Burlington. Actually surprising that that place actually had green growth across the real estate sector there. But let's talk about Toronto in particular and what I want to pay most attention to, and that comes into the sales and inventory. If we slide down here, guys, what we're going to see is the Toronto housing inventory versus the sales. And coming into April here into May, we've seen a divergence between the number of homes hitting the market, people that want to get out, and then obviously the number of homes selling have decreased pretty dramatically. And what I think we're seeing here in this massive uptick is people starting to realize that real estate might very well be correcting, and they want to get out at these absurd prices while they can. And then what I want to look at here is the average days on the market. This is very interesting data to me because it really shows the defining factor between the rich and the poor, in my opinion, or at least the middle class. Because when we look at the average homes, which I don't even know why there's data for 0 to 250K, which are selling immediately. And let's be real, if you can get a house for 250K, it isn't going to sit on the market very long. And if you can find a place in Toronto where homes are selling for that, it's got to be utter trash, like literally a parking spot at best. But when we look at the average home for the median income person going from 250K to upwards of $1 million, we're seeing those homes sit on the market for a lot longer. The prices were so inflated. People are probably a little bit more hesitant here, and they're waiting. They're probably just waiting it out like I am. They just want to see how this unfolds, right? So we're starting to see this longer period of time for these median income home houses to sell. Whereas let's talk about, more particularly these rich homes going from 2.5 million to 3 million, they're actually sitting on the market for a lot less. And the reason I think that is if you have 5, 10, if you've got millions of dollars in the bank, you're not going to be inflicted by the middle class problems of inflation and these kind of recessionary periods, right? So it's no surprise that higher valued homes aren't sitting on the market for as long. But kind of moving out of the Toronto market, what's going to get absolutely devastated here, guys, is going to be development. Now, development is so based off the speculative market into the future. And I've been hearing people out of Millennial Money, they have brought a real estate guy on that manages thousands of properties. And he's talking about one aspect of their businesses being the buy and flip business. And I wanted to take a quick listen. This is very intriguing.
All I can tell you is that my buyers on our fix and flips have softened to the point where we are now having a gut check of like, holy crap, we got to buy less properties right now because we don't want to be holding. Right now, we have 18 properties we're holding with hard money.
Yeah, on short-term flips, I'd say it's more risky.
So obviously, if home sales slow down, these people that are buying homes to do quick flips in a month or two, if it takes longer for those homes to sell and those home prices aren't as high, it really eats into the margin and the expenses of that property sitting on the market. And this is very scary for development. I know a lot of people have been saying that there's more demand than there is homes on the market, but that does not matter in a period where, the middle class doesn't want to overpay for homes in an interest-raising environment, right? So this is going to be a very sketchy time for growth-based speculative aspects of the real estate market, again, being development and high growth capital gain areas like the GTA and obviously Toronto, right? So let's talk about the REIT sector real quick, because this is where I primarily get my exposure to the Canadian real estate market. And it's almost been like an indicator that now that we've seen these REITs correct, and they actually started correcting earlier than the real estate market did, maybe this is a telltale sign that what's to come for real estate in general. But this is where I would rather play, because I think there's still better value in REITs, because a lot of them trade against their under their NAV price, which is just basically their underlying asset value versus what you're paying for it in the stock. And again, REITs are very confusing because they don't correlate directly to the underlying asset value. But nonetheless, guys, RioCan, Canadian Apartment Properties, Smart Centers, these are all REITs that I love paying close attention to, because I think that there are still an insanely good buying opportunity. Even though, say, something like RioCan has huge exposure to Toronto, the difference between now and where they were in the March 2020 crash is night and day. Not only did they strengthen their tenants, remove the terrible ones that couldn't survive the pandemic, but they paid down a lot of debt and have an incredibly large amount of cash capable to them in revolving credit lines and just in general cash, right? I mean, RioCan's got over $1 billion. This company is robust enough to basically take advantage of any correction that we're going to see. And that's why I absolutely love them, because they really, they use the pandemic to strengthen their underlying fundamentals. And I hope that's what most people would have done in that period. But again, because real estate was going up so aggressively, I think people got too greedy, whereas these companies that are primarily based off rental income really got a little more skittish, and they had time to correct themselves, whereas an individual that's been buying and flipping, maybe not paying as much to rental income, might have overlooked the problems that were on the horizon, which I've been calling for forever here, guys. And like I said, I've been one of those people preaching the bear market's coming for real estate in Canada. But again, you could have bought real estate and flipped it over the last year. I've been saying that and have made money, but now we'll see if real estate drops and kind of gives back a year, 2 years, 3 years, maybe like a lot of these speculative companies are doing. I mean, some of these companies have wiped out 5 years of value. I mean, whether you're talking about even things like at the scale of Alibaba, again, Shopify, I mean, we're seeing just everything correct, right? But I want to pass the question off to you. What do you think about this? Because my biggest fear is what happens if you just put an offer in on a house, let's say a month ago, and the closing date's coming up, and you quickly realize that that property has now dropped more than it would cost you in legal fees to terminate the deal. Because if you terminate the deals, you usually get fined, but if that fine is $30, $40, $50,000 against $1 million house that's now only worth $800,000, it makes it more intriguing for people to walk away. We're going to see some fascinating stuff happen here, and I want to know what's going on in your area and how you're experiencing this real estate market. I'd love to hear about all of it in that comment section below, but stay cool, stay awesome, and as always, I look forward to catching you in the next one.